Hello there, everyone. This is Greg Towner with Parallel Portfolios, and welcome to our market update for the month of October. This month we want to take a look at an update on the stock market price trends, both here in the U.S. and internationally. Then we want to take a little bit deeper dive into the international markets, what we're liking there. Of course, it's the 30th anniversary as we record this of the infamous Black Monday market crash, so we felt like we should at least bring that up a little bit. And then what does the bull market tend to do in the later innings, just in case we're nearing it? So if we take a look at the price trends of the U.S. markets here, as we've been talking about, as the two-year chart continue to be healthy, strong uptrends. We've had a few modest pullbacks along the way. None lately. We've just been amazingly, steadily higher. At some point, we're going to have another pullback just to kind of shake off some of the complacency in that. But for the time being, we just keep marching higher, and that we'll take it while we can. So developed markets internationally here, again, similar picture, even a little bit stronger than the U.S. this year. Not really much of pullbacks in the last few months to speak of. Nice march higher. Again, a little extended, could have pulled back, sure, maybe even that would be healthy to shake off some of the complacency. But in the meantime, a nice move higher. International emerging markets, even really the strongest this year. I mean, look at this price uptrend here, barely even coming back to the 50-day moving average, very strong. Again, a little extended, maybe it pulls back, maybe it doesn't, but really nice, healthy moves in the emerging markets. So let's stay on the topic of international here for a moment. I mean, there's different reasons why we've been talking a lot about international markets this year, why we've liked them. They've been the top performers this year. Some of the international markets we view as a better valuation than the U.S. Some of them are still doing the quantitative easing, where the U.S. is starting to reduce that a little bit. You look at emerging markets in particular, they have higher economic growth on average than the U.S. But these charts here today are another reason why we're drawn to international from a longer term perspective. On the left here, this is the emerging markets, a 10-year rolling return. So what we see over the last 10 years, both the emerging and then international developed here on the right, really around 2% average returns. We don't have this chart here today for the U.S., but it would be up, recovered halfway, not to the tops of these peaks, but it would be more halfway recovered. So the international markets, while they've done really well this year, it really lagged for a number of years, as we remember. So there's a lot of room for the international markets and emerging markets to recover and have good, healthy returns for years to come. There'll obviously be volatility along the way, particularly in the emerging markets. But when we take a step back and look from the longer term, we could see several years from now looking back and saying, hey, that was a good long-term entry point, even with the returns this year. All right, so 30th anniversary of the Black Monday market crash. For those of you not aware, hopefully you're not seeing it in the news today, because that means you're avoiding the financial media noise like we tell you to do. But nonetheless, 30 years ago today, Black Monday, it was actually, stock market crashed here in the U.S. more than 20% in one day. So we want to take a look at some past market crashes compared to where we are today, just really more for fun than anything. But we can see this red line here. This is actually the 1929 market crash. Gray line, 87, and then this black line today, all kind of at an equal starting point. And we can see there's two major differences between those crashes and what's going on today. You can see in both the 29 and 87, they'd already had major low high points. They put in their peak at a lower high point. Markets were already kind of rounding, distributing, and had a lot of volatility, a lot of action going on there before they had those big 1 and 2 day crashes. If we look at present day, as we just showed in the trends, really steady moves higher, no distributive tops at this point. What's the other major difference? Well, hey, look at these massive returns in the last 18 months or so prior to the crash. I mean, these markets were up 60, 70% plus just in those less than 2 years leading into the top. I mean, as strong as our markets have been here, we're only up, I say only up about 25% in the last, call it 18 months. So not that we have to get to those returns by any stretch, but just a couple of big key differences there between what we saw before those crashes and what we're seeing today. As we talk about those big returns in the, before those crashes, basically those were the late innings of the bull market. If we talk about a baseball analogy with the baseball playoffs going on now, a lot of people forget that some of the best returns in equities occur in those late innings of bull markets. And we don't know if we're in the late innings now. We don't know if it's the 5th inning, the 9th inning, what have you. But we do want to point out that basically in the last 12 months prior to the end of a bull market, average returns are about 25%. Median return is 21%. You don't want to take the risk of missing those returns. For the entire bull market cycle, the last year on average counts for about 1/5 of the whole cycle returns. So it's important to not just get afraid that, hey, maybe the market's come too far too fast, or there's turmoil in DC or what have you. There's always risk to the market. That's part of the volatility that is incurred. But if you have a risk management plan in place, you can try to benefit from some of these returns. So in summary, price trends remain strong in the U.S. and internationally. Particularly we like international markets. We want to gain exposure or keep exposure to them because we think longer term they have some good potential. The price action in the past major market crashes, not really too similar to what we're seeing today. It doesn't mean we can't have corrections, obviously, and who knows, we can't ever rule out a crash, but based on past history, not really seeing similarities. Late stages of the bull market, we don't know if we're in the late stages. Based on history, we might have a hitter's duel, a slugfest still yet to come to push it even higher before ultimately it ends. And the reason that often happens is because when you see those big returns, it kind of draws the last people in, they get excited, and you get sentiment too high. We don't think we're there yet. Doesn't mean we have to get there anytime soon, but something we're going to keep monitoring, of course. So thank you for joining us again this month. We hope you have a great fall. If you have any questions, please contact us. Thank you so much.